Today, we are going to have a special session with our partners at ARK, Yassine and David. Yassine and David, we're incredibly excited to have you on the show. I think let's get started with some introductions for some of you in the audience that do not know David as well as Yassine. Maybe Yassine, you want to get started. Tell us more about you. What are you focusing on at ARK? And then tell us more about your story on digital assets and how you got your first Bitcoin or your first Ethereum and what got you into the space.
Sure. Thanks again for having us. We're super excited about not just this conversation, but the broader partnership that is forming before our very eyes. As alluded to in the slide deck, I'm the director of digital assets at ARK. I joined in July of 2018, so a little over 5 years ago, focused exclusively on just the broader crypto market in two ways: research and education, first and foremost. So figuring out ways to, I'd say, formalize research around the asset class, and then also just product building, where ARK was the first public fund manager to gain exposure to Bitcoin back in 2015 through GBTC. We are a registered investment advisor. We offer 40 Act products, which also means that in the early days, the mechanisms by which we could gain exposure to crypto were quite limited. They were limited to really publicly tradable securities. So you had GBTC as called the most efficient way to gain exposure to the underlying price movement, and then derivative exposure through public equities, whether it's a Coinbase or a Block. And part of my role has been to figure out ways to gain more efficient exposure beyond just that limited product scope that we had in the early days. My jump into crypto, I wasn't a Bitcoin OG. I discovered it in early 2017. In college, I studied systems engineering and finance and was really fascinated by this intersection between, call it, broader economics and technology, and stumbled upon Bitcoin my junior year and was really just fascinated by a ton of just the convergence across multiple disciplines. And the way that kind of defined Bitcoin was really kind of highly dependent on the areas of interest that were aligned with you. So whether it's a philosophical endeavor, a political endeavor, a monetary endeavor, a technological endeavor, there was so much convergence that deeply resonated with me, and committed to falling down the rabbit hole. And so dug deep into the technology and committed to finding a full-time role where I could focus on doing this exclusively. During that time, I had purchased my first Bitcoin. I'm from Morocco, and the first Bitcoin I purchased was on Local Bitcoins, which no longer exists, but it was a peer-to-peer marketplace where you're literally just transferring cash and receiving Bitcoin. So there wasn't the traditional exchange. And obviously a lot has matured since then, but an interesting anecdote to say the least. Fast forward 5.5+ years, and here we are, and really excited about just how things have evolved and how my interests have evolved with it.
This is really incredible because this asset class shares a lot of commonalities with sports, where people coming from different backgrounds around the world, they speak the same language and understand each other for really one goal: to make this asset class easier to understand and easier to access as well. And I think understanding and access are the two main points that I think us as a firm, as well as you guys, are really trying to achieve here. And that's really exciting. What about you, David? Tell us more about you and your story.
Yeah, so joined ARK in January of last year, almost 2 years with the firm. My Bitcoin story, just as you've seen, goes back to 2017 in terms of obsessing for a few months nonstop over the asset and how aesthetic and interesting it looked to me at the time.
Yep.
On top of that, like I came to Bitcoin as a trader, but then fell in love with the rest of it: technology, the monetary policy, etc. And through that, more into 2018, I became obsessed on a subset or an aspect of Bitcoin, which is its data. And following in the footsteps of people like Nick Carter, Willy Woo, thought that the on-chain analysis field was quite interesting, as opposed to just looking at price action and derivatives of price, for getting a sense of what Bitcoin is doing health-wise at any given time. So being obsessed with that now, way back in 2018, after Nick Carter published Realized Capitalization, which will explore in the webinar today. I co-created MVRV Ratio. And since then, if you're going to the now well-known sites like Glassnode, Metrics, StoQuant, meaning the Bloomberg equivalent, where most of the crypto fundamental analysts or crypto traders obtain their EV to EBITDA equivalents in the crypto world. A lot of the metric in those websites I created since 2018 includes MVRV ratio, which we'll go into today, the Puell multiple, and a few other iterations over the years. So I'm mostly known for that as an on-chain researcher. It's one of the reasons I was onboarded into ARK last year. And yeah, pretty happy how things have developed over the years. Crypto is never a boring industry, and looking forward to our conversation today.
No, it is definitely a burgeoning asset class and changing all the time. There are always stories to tell. And I think the access point to better understand the asset class actually comes from the transparency of the ledger, the transparency of the blockchain technology itself. When people are seeing the blockchain of Bitcoin and Ethereum, they're seeing a series of letters and numbers, and it doesn't make a lot of sense for the end investors. And that's why we're incredibly excited to unveil the on-chain standard that we're going to shortly present to the audience here for the investors to know that the next generation of financial analysts and the next generation of investors trying to actually have access to this asset class would need to better understand blockchain analytics first, the same way you're waiting for, at the end of each quarter, the quarterly earnings report from any companies around the world, whether it's Tesla, whether it's Coinbase, etc. And we can have that at the fingertips of everyone in real time, 24/7, thanks to the transparency of the blockchain technology and thanks to specialists like 21 Shares and ARK to really push metrics to help the investors understand the market tops or the market bottoms ahead of time as well. So we're incredibly excited to actually present a framework for the investors to actually understand this asset class a lot better and more efficiently as well. So I'm going to leave the floor to our wonderful Carlos to walk us through the 21 Co on-chain standard that basically divides fundamental metrics and momentum metrics into one bracket. Carlos, tell us more about it. It's a very busy illustration, but let's go step by step into it for the audience.
Sure. Thanks, Ellie, for the intro. And as you alluded to previously, the nice thing about on-chain data is that it allows us to basically explore these kinds of metrics 24/7 in real time, unlike traditional companies where you have to wait for quarterly releases or for static kinds of data. Our framework is really simple. We divide the on-chain data into two buckets. The first bucket is fundamental metrics. As the name suggests, this delves into the asset's intrinsic value drivers, such as cash flows and growth, similar how you would look at financial statements for companies like Tesla or Apple. You can look at the financial statements of these networks or these applications in real time. So you can look at the treasury, you can look at the income statements, and you can look at the cash flows. But because we're talking about crypto protocols here like Bitcoin or Ethereum, you can also look at network health metrics, such as the security or the monetary policy of the blockchain, as we'll explain in later slides. And Tom will walk you through some of our dashboards so that you can get a better sense of how this works. And on the other side, the other bucket of metrics is momentum or market sentiment metrics. As the name suggests, this doesn't relate to the quality of the asset, but it relates more to asset flows and investor behavior based on their P&L. So when we look at momentum metrics, we're basically looking at wallet movements, for instance. The long-term holder behavior is another example. And you're looking at the P&L of investors to basically gauge if we're in a moment of euphoria or maybe we're in a moment of more uncertainty and fear in the market. So it's two very different kinds of drivers. The first is driven by security, economic sustainability, and growth. When we look at price, really, that is driven by supply and demand. And it's not always the fundamentals, but more about the narratives about fundamentals. And you can combine both of these metrics to create relative valuation multiples that allow you to identify short to midterm price inefficiencies and also to get a better sense of if you're getting fair value or not when you're investing into one of these assets. So if we go to the next slide, I think it would be helpful to look at just some examples, and then we'll show you some of our dashboards. So for fundamental metrics, we can look at two categories. We can look at protocol health and financial statements. When we look at protocol health, one of the most important metrics for Bitcoin, for instance, is its hash rate to measure the security of the network. We can also look at the revenue of miners because they are incentivized to basically secure the network. So it's important that they are profitable from a security standpoint. And similar for Ethereum, which has a proof of stake consensus mechanism, it's important to look at the amount of staked ETH in the network, which is around 40 billion, if I'm not mistaken, as of right now. And it's also important to look at the validator revenue. And for the applications that are on top of these networks, such as Ethereum, it's also important and relevant to look at the financial statements, which you can actually get from the blockchain in real time. So if you look at an application, let's say Uniswap, you can source from the blockchain the revenue that the protocol is getting just by looking at the fees that are paid by end users. And you can look at the cost of revenue of some of these protocols, such as with things like token incentives, the tokens that are paid like to liquidity providers, for instance, as incentives for using the protocol. And you can also look at growth metrics, such as the number of active addresses as a proxy for new users, or total value locked, which is a crypto native metric akin to assets under management. And with this, you can, as I mentioned before, construct financial ratios or relative valuation multiples, such as a price to fees ratio, which is similar to a price to revenue, or market cap to TVL, which would be another relative valuation metric. And then finally, when we look at the momentum metrics, you can look at asset flows. So for instance, we have seen a lot of flows from Binance wallets in the past 24 hours due to the news yesterday. And Tom will walk you through some of our proof of reserves dashboard. And you can also look at P&L indicators, which refer more to the state of profit and loss of investors based on when they bought some coins, which David will explain much more eloquently than me later on. And also have some multiples here, such as MVRV or...
Yeah, absolutely. I think it goes back to the question for the investors based on their investment style, as you can see on the y-axis or the time horizon in the space, whether they want to invest within 18 months into Bitcoin or Ethereum or the long tail assets, or they want to invest for the next 5, 7 to 10 years, like venture capital investors. There is a specific focus for the metric that they should be caring about. And I think we have 3 main gradients here. So A, B, and C. For the investors, for example, A, that are more passive in terms of their investment style, but long-term oriented, they should be focusing more on fundamental metrics compared to momentum metrics. However, if you're an investor trying to invest in the long run, but you're actively looking at a portfolio once a year, once a quarter, once a month, both metrics, fundamentals as well as momentum metrics, are the ones that they should be focusing on to ensure that they know the market sentiment on one side for the momentum metrics, as well as, of course, the fundamentals of a specific protocol, like the revenue of the miners, the cash flows of Ethereum stakeholders, etc. And then the last gradient, you can see, number B, is more swing trades or momentum-based strategies. So these are active investors, but really within the short run framework where they want to invest within, for example, 3 months or even like a day, right? And momentum metrics will fit their needs perfectly for that. So that's basically our on-chain matrix that we built here alongside the research team. And of course, the incredible invention from David back in 2019, where he basically co-created MVRV, one of these multiples that actually measure the market sentiment and also predict to some extent the market tops and bottoms. But I would let David talk about that in the next few slides for that. But let's give you guys first an introduction of both fundamental metrics as well as momentum metrics in real time with our Dune Analytics dashboards. And I would let Tom walk you guys through some of these key metrics that you should care about, whether you're long-term oriented, passive, or you're short-term oriented and active. These are the two kind of metrics that you should be focusing on. And we have that as well in real time on Data Analytics. Tom, you want to go ahead?
Thanks a lot, Ellie. We have a really good framework, but learning the framework is not enough, right? And therefore, we have the exact tool to help you to grasp what are actually happening in the blockchain. Now you learn about the theory. So now you can actually look at the data itself and look at yourself and see how it works in the future. So first, we look at the Bitcoin time and hash rate. So in the graph on the right, as Carlos previously mentioned, network security is a really important metric to analyze whether a crypto asset or a network is in good shape or is healthy in the long run. And in this graph, what we're showing here is that in 2020, we have seen a huge drop in hash rate. So what happened back then? So a little bit step back is hash rate is a measurement of the computing power being used for minings. So when the hash rate goes down, it means that a lot of miners are not mining the Bitcoin. Therefore, the hash rate or the amount of computing power has dropped significantly. But what happened back then is due to the fact that a lot of Chinese miners are forced to go away or move away from China due to a Bitcoin mining ban back in 2021, May to July level. And therefore, we've seen that the block time, which is the time between blocks and blocks, for example, if the block time is higher, which means that it takes longer time for a block to get confirmed. And due to the fact that the computing power has dropped significantly, the block time also increased. But we have seen that the hash rate afterwards has grown sustainably, and we are back in the healthy shape right now. And the hash rate in recent days has been higher than ever. And quick intro about the Bitcoin security and how we can leverage hash rate to understand network security of Bitcoin. So the next metric, we'll be introducing ordinals inscription. The theory of ordinals inscription is very similar to what we're seeing on Ethereum blockchain called NFTs. Ordinals inscription is not just about JPEGs. So what it can do more is you can inscribe, it's meaning that you can store some data on the Bitcoin blockchain. So what data you can store is not just about images. You can also store text, you can also store files, different types of files. So for images, it would be very similar to NFTs on the Ethereum blockchain. But for text inscription, it could convert and transform into a token format. It's similar to a token format, but not exactly. And therefore, we've seen that the adoption of the ordinals inscription has skyrocketed because it is a very innovative and new theory that has happened to Bitcoin that hasn't been seen over the past several years. And therefore, we're seeing that the hype towards Bitcoin blockchain adoption has increased accordingly as well. And if we go to the right chart, we're seeing that the fees generated from this ordinals inscription has been increasing sustainably as well. So previously, without the ordinals inscription, the percentage of fees is just very, very, very low comparatively. But with the introduction of ordinals, a lot of the users actually are more willing to pay for a higher fee to get their data inscribed on the Bitcoin blockchain. And therefore, we're seeing that almost 50% at its peak of the transaction fees are paid for using ordinals inscription. Therefore, we're seeing that the growth of Bitcoin is actually having a new type of adoption here. So if we think about the fundamental metrics that we mentioned earlier, it is type of a growth metric that has been happening in the Bitcoin ecosystem here.
And I think it's really relevant for Bitcoin because people talk about Bitcoin as digital gold. And Yassine and I, alongside Ophelia and Kathy last week, we discussed the case for Bitcoin as a monetary revolution, but also potentially as a case for the next generation of internet services. And now we're seeing new features and innovations built on top of Bitcoin that are very similar to what we're seeing on Ethereum that could expand, of course, the total addressable market for Bitcoin beyond the $12 trillion target, which is the market cap of gold today, right?
That's right. I mean, I think that a lot of this data, what it ultimately suggests is the ability to at any time monitor economic activity and the nature of that economic activity. And through Bitcoin's over decade history, the nature of that activity changes. I think ordinals in 2023 is a really good example of how you have experimentation on top of Bitcoin, actually just leveraging Bitcoin's protocol and technical implementation to see additional use cases emerge. And this also just points to the free market nature of Bitcoin as this open source software, where you have these users that are participating in this, call it mini closed economy, and are willing to pay for block space based on whatever demand they have to use that block space. And that changes over time. But the beauty of on-chain analytics is you're able to monitor that in real time. And so you could see deviations, you could see outliers. Tom mentioned the drawdown in hash rate and attributed that to a specific news event. Now we're seeing a spike in fees, and we can attribute that to the ordinals. And so again, just really I'd say provocative way to understand underlying fundamentals, I think in a way that no asset class provides. Really interesting stuff.
Yeah, for sure. And I think it goes back as well to some of the news events that we've seen yesterday with Binance. And as many of you know, we also track the addresses of Binance on several blockchains, including Bitcoin and Ethereum. And I think, Tom, it would be great that you give a recap to the audience of what happened to Binance yesterday, and then walk us through the market impact on Binance itself.
I'm sure a lot of us have already heard about the news, which is one of the largest news this year, I would say. So CZ, the founder of Binance, will step down, and then Binance will also pay a huge fine, which is up to $4 billion. And in return, Binance will settle with the SEC. There will be no longer any continuous criminal charges towards Binance, but then they will need to pay a huge fee, and CZ might need to serve some jail time as well.
The DOJ, by the way. Not the SEC.
DOJ. Sorry about that. Yeah. And back to the dashboard here. As previously mentioned, it's important to understand the fundamentals, but in the meantime, it is also a very timely, or another strategy that you can adopt is using a momentum strategy. And as we are seeing in this dashboard, first usage is obviously we can understand the risk of different exchanges, because centralized exchange ultimately is a centralized party that you need to trust. And therefore, you will have counterparty risk. And what we're seeing here is we can see the real-time balance of this exchange. And then we can track whether there are any fishy activities that are happening, or whether there are any huge outflow that are coming out from this exchange. First of all, what you can see, or what you can leverage via this block dashboard, is understand whether the centralized exchange is in good shape, or whether they are doing any fishy activities based on the transaction that have been through. Or for example, the balance has dropped significantly in a single day. And that's something you might need to dive deeper into and understand what happened behind the scene. And in the meantime, what we can also do, which could be potentially a cool strategy, is, but obviously not financial advice, but you can see who is depositing and who is withdrawing from the centralized exchange in real time. For example, in some cases, if there's a huge deposit of a certain token, it could potentially mean that that wallet address is planning to sell that crypto on the centralized exchange. But obviously, it's not 100% guaranteed, because they can just deposit and then withdraw the same amount. But in some cases, we have seen that whenever there's an address deposit, for example, a huge amount of a crypto asset, afterwards, they will withdraw a certain amount of stable coins, which could mean that they sell that crypto on a centralized exchange. So that's a strategy we can think about, or we can take reference to whenever there's a deposit, a huge amount into a centralized exchange. That could be a strategy, or that could be something we need to monitor in the future to ensure that the health of the token and the health of the centralized exchange.
So what happened to Binance, Tom? Tell us more with the numbers.
As previously mentioned, obviously there's the huge news breaking out would impact the trust towards the users of Binance. And as a result, we're seeing there's quite a huge outflow coming out from the centralized exchange of Binance. But compared to previous outflow, it is not as significant. Back in November 2022, which is during the collapse of FTX, which has greatly impacted the trust of centralized exchange, and therefore a huge outflow, which is up to 8.4 billion coming out from the Binance centralized exchange. And it is actually in December, because there is a fear and uncertainty due to the rumors regarding the Binance solvency, actually back then they are able to fulfill and honor all the redemption. So it's a good sign. And yesterday's outflow is nothing compared to back in December, which is also a good sign that users, even though they're withdrawing, but then it's not as significant, like the trust level is not impacted as significant back in November 2022.
I couldn't agree more, for sure. But the good thing is that we can monitor closely the situation to ensure that we know whether we have any outliers happening on Binance and any other exchanges as well, of course. But the good thing is that we have that in real time. And after this call, for everyone in the audience, you're going to receive the link to the dashboards to play around with them as well. Fantastic. And now let's get to the gist of it. So, David, you co-invented market cap to realize value almost 4 years ago, if I'm not mistaken. Tell us more about this metric that you co-invented at that time and what brought you to actually co-invent that metric and why it matters today. So I'm going to share my screen so that people have a visual for this incredible metric. But David, the floor is yours to walk us through.
Thank you. Thank you, Ali. So what you're seeing here, a little bit of background on the invention. This came out of Nick Carter and Antoine Nicolvet from Coinmetrics, publishing a new metric for Bitcoin called Realized Cap, which I'll explain in a bit. In 2018, it was, I think, October or so of 2018, we had first access to the data. My friend Murat Mahmoudov and I delved into the data and pretty much realized that there was a way to come up with a mean reversion mechanism or a way to measure how much the current market value of the network or the price of the network is diverging from the cost basis of the market. That's the punchline. So imagine technical analysts over the years, by using the 200-day moving average, they've been trying to attempt capture a hypothetical cost basis of the price of an asset and measure the divergence from that cost basis to price, and then get a sense of overbought or oversold conditions over time. Within that, what you get with realized price, let's talk about the primitives of the metrics first. The primitives are market capitalization. As I'm sure it's very familiar to the audience, just time current price by the total outstanding supply of the network, the number of Bitcoins outstanding. And then in the denominator, you have realized capitalization, which is the major innovation that it's only allowed for due to the transparency of the Bitcoin network at any given time. Realized capitalization, instead of multiplying each coin by the current price, the multiplication goes to the price where the coin last moved. So if the coin I'm analyzing at any given time moved in, let's say, 2018, it will be price stamped with the price of that specific date as opposed to the current price. And when you think about that, you're in essence getting the aggregate and the cost basis of the market because you're detecting where every coin was last moved or last bought, which is very significant. Instead of having a hypothetical of mean reversion, you can actually measure the market value to its cost basis and get a sense of overbought or oversold conditions at any given time. Now, the way to use it, you can see from the chart here, it's very simple, meaning for the most part, all things being equal, high means overvalued, low means fair valued or undervalued. Specifically, to give you an example, when market capitalization goes below realized capitalization, meaning MVRV, the ratio of the two is below 1, that means that the unrealized profits are not profits, and we actually have unrealized losses in the aggregate of the market for the most part. So most people are at a loss, capitulation, and as you can see from the chart, that usually correlates in periods like late 2011, 2015 to 2016 or so, 2019 and 2023, early 2023, just recently. Those are periods where we see deep value in Bitcoin. And it's also very much a contrarian indicator in the way it portrays pain in the market, which allows you to get a sense of when potential accumulation can occur in your portfolio.
This is really incredible. And I think this is the first time ever for any asset class that we can see in real time the aggregated cost basis for the investors. And of course, David, maybe walk us through the caveat of knowing that some addresses may be hosted by multiple exchanges and exchanges have several customers. How do we tackle the pseudonymity of some of these addresses, where sometimes we know that these addresses are probably associated with exchanges or actually with service providers? I think understanding more of that methodology aspect would be also helpful for the audience.
Sure. So several replies to that. The first one is, for the most part, you're looking at an aggregate. A lot of the noise gets segregated when you're looking at such a big bracket of pretty much as the market as a whole, as opposed to a single address transacting back and forth. That's crucial in terms of diagnosing economic data in Bitcoin. For the most part, we look at aggregates to increase signal to noise in analysis. Secondly, you can also entity adjust. On-chain analysis, I feel it's gotten to a high level of sophistication at this point. What you see here is not entity adjusted, but there's several versions of MVRV or realized gap in the market today that actually entity adjust the metrics. And what that means is, let's say you have Coinbase or a single whale, a single entity owning a lot of Bitcoin and trying to game this metric and transacting between itself back and forth, right? I have my address A and my address B. I own both, and I just transact back and forth in different prices, and then therefore I can put noise on the metric. One, there's a cost to that, time consumption and also fees consumption to that. And also there's, if you're a big whale like early adopters, for the most part, those people tend not to want to move coins because their balances have been quite, let's say, are highly secured and obscured by their owners. But on top of that, you can entity adjust so that you can remove all the transactions that took place between the same entity or the same owner as opposed to two different owners. So that's another way to segment the data. And then there's a few other iterations where you can actually transform MVR so that it's more effective and not as prone to take effect from, let's say, noisy transactions.
Yeah, no, it makes a lot of sense. And I think this is really one of many metrics that we are seeing from you guys. I know you also published a paper in earlier, I think Q3 this year. Can you tell us more about some of the things that you guys are focusing on as well in terms of on-chain research and pioneering new metrics?
Sure, I'll go on a very high level over it. So the name of the paper, we co-published it in collaboration with Glassnode, which is one of the most robust providers of the data we went through today. It's called Cointime Economics, a new framework for Bitcoin analysis. And in essence, we hold the thesis that the time of holding for any given coin in the Bitcoin network is highly important to diagnose how strong the holder base of the asset is at any given time. To keep it at a very high level, we introduce metrics like the coin block, which is a new unit of economic account that measures both the volume of coins at any given, let's say, transaction, but it adds the time of holding component into the same unit of account. And that allows us to get a sense of how many coins are dormant at any given time. For instance, we can come up with metrics that know that historically over the lifespan of Bitcoin, more or less 60% of the network has moved. 60% of coins have economically moved over time. And conversely, 40 are vaulted, and so on and so forth. So I would recommend that, especially for the more advanced analysts that have some familiarity with on-chain research, to go into that piece. And we have a lot of things coming up into next year that always leverage on-chain analysis and how to best inform investors when analyzing Bitcoin and other crypto assets.
This is great. Yassine, do you have anything to add to that? And of course, for the audience, you're going to receive all the links after this call via email as well to understand more some of their works as well.
Yeah, I think the time factor component is really important to understand, both in terms of the MVRV that David discussed, but also in terms of coin time economics, where for the first time you have an asset that you don't look at exclusively based on just value, or the value itself is not what's fungible. There's also a factor of time that basically allows you to diagnose, again, the economic weight of an asset more than you would have previously. It's a very simple example of that is like, if one Bitcoin transacted that last transacted, let's say yesterday, the economic weight of that Bitcoin is a lot less than if one Bitcoin transacted and the last time it transacted was Satoshi's coins. So it took 10 years before we saw a movement in the Bitcoin network with that specific Bitcoin. And so I think what coin time economics does is it is able to measure that economic weight based on time. And so now you have this sort of fungible unit of account where, to David's point, you can then derive the market mean, you can derive active versus inactive supply or vaulted supply. And so there's a wealth of data that you're able to understand when you overlay that time component. And then for the realized cap, imagine the analogy in the equity world is, let's just say that you were able to see every shareholder of, let's say, Tesla's stock, when they bought it, at what price they bought it, and when they're selling it. And let's say that Tesla stock, the value was exclusively derived by the demand to hold the asset, right? There was no sort of reconciliation to cash flows. So the only way to determine value was based on holder behavior. That's what you have with Bitcoin, right? If you think about Bitcoin's value being derived by reservation demand, it makes a ton of sense how you can then use this economic behavior to assess under overvaluation. And that, as we're thinking about where research is and how you're converging between research and investing, we're active managers in the space. And a lot of the active management is derived from this on-chain analysis. So a lot of, let's say, more novice investors who are just getting in, they often ask the question, how do you value Bitcoin? How do you value these assets? It's impossible to value. You don't have this discounted cash flow model that you can just plug in to Bitcoin. I'd say one, we started to see that in what Carlos presented in terms of just the broader framework where you can create analogies to revenue and COGS and just broader sort of financial statement metrics that are more colloquial and easier to understand. But two, you now have, again, an entirely new framework to assess fundamentals that simply doesn't exist in other asset classes. That's why people have trouble really understanding how to assess the fundamentals, is because it just requires you to understand an entirely new set of metrics and fundamentals. And so that's why we're excited, as is I'm sure 21 Shares, to bring this framework to life by drawing analogies to the old world, but also and standardizing it in our own way. And I think things like cost basis of the market, realized cap, these are things that simply did not exist in other asset classes. So really exciting in terms of just the nature of the data that we can now analyze.
For sure. And it's really incredible that we now have an asset class where we're able to learn from traditional finance and actually replicate some of these key metrics that helps investors understand the fundamentals as well as the momentum of a specific piece of technology or a piece of a company, while at the same time helping people by building bridge into the asset class so that they can understand with this new framework that we have new metrics that you can leverage in real time. And if actually you are not focusing on any of these momentum-driven metrics and you're more of a long-term driven investor, you can cut out the noise that happens every single month or every single quarter and just looking at the long-term view of the investment case. We talk about Bitcoin, but there is a lot as well to unpack with Ethereum. And I think that would be a great over session that we can actually have together to talk more about some of the metrics that we can leverage with Ethereum and the long tail assets. But I hope for the audience here, the framework was really helpful for you guys to now better understand how to leverage blockchain data and blockchain metrics and signals in real time and really adjust your, I would say, attention to these metrics based on your investment style and time horizon. But I think I'm going to leave it here for a Q&A session from the audience. But the first question that I have before giving the floor to the audience is to David and Yassine. What are you guys excited about for the next few months in crypto?
I think that there's a lot of development on a regulatory front that we're quite excited about. We look at this relative to everything that happened in 2022 and how it left quite a bad aftertaste in a lot of people's mouths, both within crypto and outside of crypto. A lot of contagion that ultimately ended up being a function of centralized mismanagement and counterparty risk. And so into 2023 and now coming into 2024, to see a lot of these public blockchains not just surviving but thriving in the wake of this contagion has been quite, reassuring and promising just from a fundamentals standpoint. And now that we have, I'd say, potentially more clarity around regulation in the US, I think this could set us up quite nicely for real institutional adoption and buy-in in a way that we really haven't ever seen. We're actively focused on what the implications of this clarity on regulation will look like for the broader asset class. But that's something I'd say is top of mind for a lot of people and something we're really excited about.
I would say watch this space for the next Bitcoin monthly report from ARK, right? Sounds good. Thanks, Ian. What about you, David?
Cyclically speaking, 2024 should be a very interesting year, even in terms of volatility. We have a halving day coming in April, according to the latest estimation, April 2024. Supply issuance gets cut in half for the Bitcoin network, which is statistically significant so far. And also, as Yassine mentioned, regulatory, let's say, there seems to be a regulatory catharsis over the last year after the FTX fiasco, which seems hopeful. We also see, similar to what we saw in 2020 with Paul Tudor Jones and Druckenmiller, we see that same emerging narrative of the flight to quality for Bitcoin, mainly driven today by Larry Fink, which is an even more important actor, not only financially, but politically as well. So I think 2024 should be a pretty interesting year, for sure. Not boring, as always, but I think in terms of the potential upside, in my view, it's an interesting year to follow.
No, I couldn't agree more with you. I think some of the things that we saw as pivotal changes in the asset class, or really, I think, stemming from the market structure of both the spot and the derivatives market structure in crypto. As we know today, the CME is the largest futures Bitcoin marketplace in the world, outpacing Binance, Huobi, and other futures exchanges. So we're seeing the institutionalization of the market structure in crypto. And I think for the spot market as well, for all these crypto exchanges, it's not going to be the same again. We've seen that with the flight to quality towards decentralized non-custodial solutions or exchange-traded products on the back of what happened with FTX in November last year. We're seeing that the ratio between decentralized exchanges and centralized exchanges increased significantly as more volume actually escaped from these centralized entities, or even the balance on the exchange as well is a lot lower compared to even the early days of 2020 for many exchanges. So we're seeing a wave of the market structure, which is very interesting, and I think would give more investor confidence into the asset class. And I would say as well, again, when we're looking at the current price of Bitcoin today compared to the cost basis for the miners or their capital expenditure of the miners, we're well above their capital expenditure. There is less selling pressure as well coming into the halving for next year. And by the way, on the dashboard that Tom created on Bitcoin key metrics, you can see also in real time when the halving would happen. So far, this is, I believe, mid-April next year, Tom, right? So probably the halving is going to also provide less selling pressure and incentives for the miners, which would be also very interesting because on average, they usually sell $20 million each day. So there would be probably less selling pressure as the price is well above the cost basis. But we're super excited about I would say the innovation as well that happens on all of these layers on top. But let's get to some of these questions that we received. We have one already. And I think that's a question for you, Yassine and David. How do you see the Bitcoin adoption through exchange-traded funds influencing or limiting on-chain analysis going forward, as individuals would basically hold BTC through ETFs? I think the question is more, is it going to make it more transparent or opaque for any on-chain analyst to better understand some of the metrics that we discussed today? What do you guys think?
David, you can take this. I'll just quickly set this up in terms of what the potential implications are here, because I think this is a great question. I think ultimately what an ETF approval means, and if there is, let's say, massive inflows into an ETF, then effectively you have institutional custodians or qualified custodians that are custodying Bitcoin on users' behalf. And any transaction or economic activity, let's say like a buy or sell, wouldn't necessarily settle on chain and instead would be traded over the counter or in secondary markets. So if I'm a buyer of an ETF and then I sell that ETF immediately, that's not going to be necessarily reflected in the cost basis of the market on chain. And so this is something that isn't just limited to an ETF, but even things like the Lightning Network or second layer solutions, or even as retail flocks more towards exchanges to facilitate transactions, a lot of the on-chain analysis will likely be obfuscated. But there are workarounds around that David can explain, just around entity adjustments, and also the role as an on-chain analyst to be able to detect when a signal is no longer valid. And I think a really good example of that, David, that you might want to touch on is the NVT ratio, which was in the early days one of the biggest ratios to determine relative velocity. And because there was, call it, less transaction volume, it did not reflect the network value as it did in the early days. But David, you're thinking about this a lot, so would love to get your thoughts as well.
I'll start by saying it has happened before where we've seen a metric get filled with noise or stop being as useful given the natural activity of the network. NVT ratio, network value to transactions ratio, is the primary example of this, as Yassine mentioned, where the NVT ratio is basically measuring market capitalization at any given time against the USD value of transactions of the network. Out of that, usually you want to see market value be proportional to transactions, to the value transacted on the network at any given time. But it was the velocity of the network has been trending down while price appreciated. So that principle, or that first principle analysis where that metric was based on, turned out not to be as reliant. However, we see several ways on how other metrics have persisted over time very reliably. MVRV is an example of that. There's a few others that not only rely on the cost base of the network, but also in security, miner activity. On top of this, we have the ability to analyze ETF, spot ETF entities individually and as a market report as well, meaning their inflows and outflows, which to some extent, although not all, determine a lot of the potential supply and demand going in and out of Bitcoin at any given time. We also monitor how the exchanges interact with those entities. The ETF entities could interact with exchanges where price discovery ultimately takes place, let's say a Coinbase, and the custodianship in those entities as well. And on top of that, we also have the entity adjustment mechanism, which is pretty reliable at this point that I mentioned previously in the webinar, meaning you can take away those internal transactions of the same owner or entity in this case and get a sense of the network on a truly economical sense. The entity as well, we mustn't forget, an entity like even a spot ETF provider will always interact with the network, whether it wants it or not, right? It has to have some movement. For the most part, you would see a lot of the inflows and outflows and that being reflected as a proxy of supply and demand. But in the case of off-chain transactions, you can also assess the entity and its interactions with custodianship, which would be very important. Let's say Coinbase custody, et cetera, et cetera. So there's a lot of ways and a lot of minds thinking about how the transparency of the Bitcoin network might change over time. And I think we stand ready for that challenge.
This is exciting. And I would say watch this space because there is a lot of work to be done for improving on-chain transparency, on-chain metrics and signals. And that's why we really share these principles and philosophy, 21 shares alongside with ARK. And that's really exciting. I'm really cautious of time. We're going to call it a day. But I want to say thank you so much to Yassine and David for your time and your excellent insights for our investors and audience, as well as for Carlos and Tom for attending the call with us. I hope it was really helpful. After this call, you guys are going to receive the recording, as well as all the resources and the links to the reports from 21 Shares, as well as ARK. And if you guys have any questions, feel free to reach out to us at research@21shares.com. Check out our research as well on the 21 Shares website, and ARK research as well on the ARK website. And if you have any questions, feel free to reach out. Always here to help and build bridges into the asset class. Guys, thank you so much. And with that, we're going to call it a day. Thank you so much. Bye-bye.
Thank you, guys.